Hi, I'm Anna and welcome back to my channel Building a Business. In my last video, which you can watch by clicking up here, I showed you how to create your own version of the BiggerPockets Rental Property Calculator for free. And in that video, I skipped over how to calculate the annualized return, and I said that I would show you how to do that in a separate video, and so this is that video. Part of why I skipped over that calculation in the previous video is because it is a significantly more complicated calculation and would take a long time to explain it in that last video. However, a bigger part of the reason that I skipped over that calculation was because I actually think BiggerPockets calculates it incorrectly. Now granted, I haven't talked with the people at BiggerPockets who created that calculator, so I don't know why they chose to calculate the annualized return the way they did, but based off of everything I can gather as to how it should be calculated, I don't think they did it right. So after you've watched this video, if you think that I'm wrong and they're in fact right, please explain it in the comments below so that I can learn and so that I can update this video to make sure other people know that it is in fact right and why it's right. That being said, let's jump into the calculations to see how to calculate the annualized return and how BiggerPockets calculated the annualized return.
Now to start off, I'm just going to show that I was able to calculate the same numbers that the BiggerPockets Rental Property Calculator calculates. So for instance, for the 5-year annualized return, if I go to my Excel and scroll over to the end, I find that my 5-year annualized return is also 17.65%. If I scroll down on the BiggerPockets calculator, you can see what their values are for a number of different years. And so you can see year 1, they both match, and that's the same with year 2, year 3, year 4. We already established year 5 matches. And then if I go for the remainder of them, year 10 matches, year 15 matches, year 20 matches, and year 30 matches. BiggerPockets doesn't provide the intermediate values, for instance, year 17, but given that all the other values match, I think it's a pretty good assumption to say that had they provided their value for year 17, it would also come out to 11.62%. Now these values that I used were based off of the same exact example that I used in my previous video, which will be linked in the description below. However, in that video, I didn't take into account any sales expenses. So I'm going to go and edit this report, and I'm going to keep all the values the same. I'm going to scroll through them slowly so that you can look at them to see what they are. Now for the optional sales expenses, right now it's 0. I'm going to bump that up to 10%. When I update the analysis, it says that the 5-year annualized return is 13.03%. And let me double check if I go back and update my sales expense on my Excel to 10%. And then go back to the annualized return. The 5-year is also 13.03%. And if we go down to the further examples, they show minus 100% for year 0. I don't think that really makes any sense, but starting at year 1, you have negative 20.43, negative 20.43, and again, all the values you can see match. All the way up to year 30, they have 8.78%, and I also have 8.78%. So hopefully by going through these 2 brief examples, you can see how I was able to get the same values that the BiggerPockets Rental Property Calculator gets. However, now I'll jump into a bit about why I think they calculate it wrong. So I was able to find this blog post by Brandon Turner, and the blog post is about 4 years old, but he describes how to calculate the annualized return. And he says the annualized return is computed by taking the total profit if sold and dividing it by the cash you put into the deal. Now we know how much cash we put into the deal. You can watch my previous video to see how to calculate that. The total profit if sold is something that we don't yet know how to calculate. Luckily, Brandon explains how to calculate it up here. So essentially, he says you take the after repair value in any given year, you subtract out all the sales expenses, In this case, for instance, on the last example, we took a sales percent of 10%, and so the sales expense would essentially just be 10% of the after repair value in that year. Then you subtract out the mortgage balance that you have left. You subtract out any money you put into the deal, and then you add in all the combined cash flow since you purchased the property. So now let me go back to the example we were just looking at, and I'll show you what immediately jumps out as weird to me. So essentially, what it seems like to me is that they're starting out the first year calling it year 0. And the reason I say that is because the property value is the same value that it was when the property was purchased, given the numbers I plugged into the calculator. And similarly, the equity that I have in the property is the amount of equity I have right when I purchased the property. So this blank year 0, essentially, from these two values and the loan balance, make it look like these are the values right when you purchase the property. And the dashed line in my mind makes it seem like that's the case as well. However, it then goes down and says your cash flow is $4,653. That would be the cash flow after a full year, not right when you purchase the property. Right when you purchase the property, you shouldn't have received any cash flow. So now to year 1, the property value that BiggerPockets calculator has calculated is $153,000. Now that would be the profit value exactly 1 year after purchasing the property if the appreciation was 2%, which is the value we chose to use for this calculation. So based off of this number alone and the values for the equity and loan balance, again, when they say year 1, these values match up with exactly 1 year after purchasing the property. However, again, if you look at the cash flow, this is how much cash flow you would get between the very beginning of year 2 and the end of year 2. So essentially months 13 through 24. This is the cash flow for months 0 through 12. And this would be the next year's cash flow. So while these values all make sense, the location of them doesn't. For instance, I would have put the cash flow as 0 here because you've just purchased the property. And then this is the amount of cash flow you've made in year 1. So I would have moved all of the cash flow values over one column. But then the numbers get even stranger when you go to the Excel that I was showing you. So let's start with year 1 and let's look at the total profit if sold. So remember that Brandon Turner said that the total profit if sold is the after repair value, which if we scroll over here, we have the after repair value. This is the after repair value essentially at the very end of month 12 or the beginning of month 13. Essentially at the very end of what I would consider year 1, but what BiggerPockets calculator considers the start of year 1. Then Brandon says you have to subtract the sales expenses. So we subtract the sales cost, which is 10% of the after repair value, or $15,300. We then also have to subtract the mortgage balance. Again, if I click on this value, you can see the mortgage balance that we used is the value at the start of what BiggerPockets calculator considers year 1, and I would consider the end of year 1. We then have to subtract the amount of money you put into the deal, which I have calculated from the previous video up here. And then lastly, you have to add the cash flow since the purchase of the property. Now this is one more weird thing that the BiggerPockets calculator does. They say, according to Brandon Turner, that they are taking into account the total cash flow since the purchase of the property. But to get the values that they have in their calculator, you actually have to take the value at the end of whatever year you're dealing with and subtract it from the total cash flow that you got during the very first year, or what BiggerPockets calculator considers year 0. So if you do that, you get the value of $8,273. Similarly, if we look at the next year, all the values are the same, as in they take the property value at the start, the loan balance at the start, and then the cash flow at the end minus the cash flow from year 1, or what BiggerPockets considers year 0. Again, that all just continues the same exact equation for all of the values of the profit if sold. Now, if you take any given year, for instance, let's look at the year 4, the profit if sold is $23,038. If we go back to the BiggerPockets, year 4, profit if sold, $23,000. Unfortunately, the BiggerPockets calculator doesn't show any significant digits beyond the thousands. However, all of the values, if you check, match up with the values that I have when you round. Now, in terms of the annualized return, if we go back to how Brandon Turner mentions that they calculate it, he says that you take the total profit if sold and divide it by the cash you put into the deal. Then you divide that number by the number of years that you held the property. That's actually incorrect. If you look at any different website, it'll say that the annualized total return is the total return plus 1 to the 1 over the number of years minus 1. Now, in the very first year, that does come out to the same as just dividing by the number of years, but for subsequent years, the value will be slightly off. Again, this blog post that Brandon Turner wrote was from 4 years ago, and that is at the time how their calculator calculated the annualized total return. However, the new updated calculator does in fact calculate the total return in the correct way using this equation. And so if we go and look at our Excel document, the annualized return for year 1, you can see 1 plus the total return, which is in this case the profit if sold divided by the money put into the deal, to the 1 over the number of years, which in this case is 1, minus 1. Now, for the second year, the equation is exactly the same, but it's 1 over the number of years, so in this case divided by 2. Again, divided by 3, and if you continue down, that is how they calculate the annualized return on the BiggerPockets calculator. And I agree that now that they've updated the calculator, that I do think, given the values that they get for the profit if sold, I do believe they calculate the annualized return correct. However, as I've just mentioned, I do not believe that they've calculated the profit if sold correctly. So essentially, if you want to calculate the profit if sold based on the way that the BiggerPockets calculator does it, you just go over and take the property value at the start of the year, subtract the loan balance at the start of the year, subtract the money you put into the deal, subtract any sales cost that you may have, and add back the cash flow that you've gotten since the purchase of the property minus the cash flow you got in that first year. The biggest issue, in my opinion, with this calculation is that you're switching up the time frame. The profit if sold should be a snapshot of the financials based off of one given point in time. However, they're not. Some of the calculations take into account the values at the start of a year, while other parts of the calculation take into account values at the end of the year. Now, I created my own version of the annualized return, which is the same calculation. However, it's using values that are all taken at the same snap point in time. So for instance, if we look at the profit if sold, I calculated both at the start and the end of the year. And I considered year 1 as months 0 through 12, year 2 as months 13 through 24, and so on. So in this case, if I wanted to calculate the annualized return at the end of year 2, I would just take 1 plus the profit if sold at the end of year 2, divided by the cash I put into the deal, to the 1 divided by 2 in this case, because 2 years, minus 1. And again, the profit if sold is the same calculation that was done with the BiggerPockets calculator. However, the values are all taken at the same point. And so in this case, it's the property value at the end of year 2, minus the loan balance at the end of year 2, minus the cash I needed to put into the deal, minus the sales cost at the end of the year, and then add the total cash flow. In this case, I am not subtracting out the cash flow I got in year 1 because that doesn't make sense. Again, if you want to see this Excel, how I did it, and play around with it, you can check out the link in the description in which I will upload this Excel document for you to use.
So it's pretty clear at this point that I personally believe BiggerPockets Rental Property Calculator has calculated the annualized return incorrectly. That being said, I don't think that's a huge issue. And the reason for that is the annualized return takes into account the appreciation that your property will see. And as a lot of rental property owners will tell you, appreciation is speculation. You can look at past trends, you can try to figure out what's going to happen in the future, but ultimately, by focusing on appreciation, you are just guessing about what's going to happen in the future. And so if you use the BiggerPockets Rental Property Calculator and find that after 5 years, the annualized return you get is not what they estimated you would get, the reason for that is most likely more due to the fact that you incorrectly guessed what appreciation would be versus the fact that their calculator calculates things a little differently than I think they should. So ultimately, my biggest advice is just to put very little stock into any calculations that are based off of any promise or assumptions about what your appreciation on that property will be. Thank you so much for watching this video. If you enjoyed it, please like it below and subscribe to get more videos like this in your feed.